Ideas are cheap. Everybody can talk about ideas, but how many people have the ability to take a sentence or an idea and make it real? The truth is, there's no ability to actually physically go through everything. That doesn't happen in reality. Everybody tries to have the perfect plan, but perfection is actually the enemy of good.
YC is a seasoned venture capitalist with over a decade of experience, having previously worked with Sequoia Capital, one of the largest and most successful investment firms behind iconic companies such as Airbnb, Coinbase, Twitch, Apple, and ByteDance.
So my personal rules are 10x, sell half.
10x, sell half.
Yeah,
Basically take profit.
Yeah, take profit. 10x, sell half.
YC is now the Malaysian partner at AC Ventures, known for backing successful startups like Coffee Meets Bagel and Carsome that have achieved a valuation of $1.7 billion.
The number one trait has to be grit/resilience, right? Because, it's like Murphy's Law, whatever can go wrong will go wrong.
In this episode, YC shares his insights on the world of venture capital, and hopefully you will gain a different perspective on how VCs achieve massive returns by replicating their tried and tested playbook.
Most people don't look at the hindsight of success, and the truth is almost everything needs to turn out right to lead to success.
So YC, what does the 1% know about investing in businesses that the 99% doesn't know? YC, you have previously worked with one of the largest family conglomerate in Asia. Now you are working in one of the largest family conglomerate in Malaysia. Clearly you are the expert in the craft of looking for undervalued and maybe even undiscovered companies. So maybe for the benefit of our average viewers, what does a venture capitalist, a VC, do? And how does a VC make money?
First and foremost, I wouldn't describe myself as an expert by any means. I just have happened to be doing a bunch of random things at random times. But on a very high level, the foundation of a VC investor is ultimately to find quote-unquote early stage companies to invest in with the hopes that one day that company becomes large. The investor then needs to find a way to actually liquidate or sell his or her own positions to actually make money, because up to that point, it's all paper money. So in short, that's what a VC investor does.
How hard is it in terms of generating profits and returns in this kind of environment? I would presume it's a pretty high risk investments, right? Because studies have shown over 90% of startups fail and 10 or 20% of them can't even pass their first year. So in that sense, can I also say that maybe your returns can only come maybe years and even decades down the road? Bring me through what kind of return or what kind of money are we talking about?
So maybe I'll break up your question into a couple of different sections. The first thing maybe I'd like to address is that venture capital or private equity is a risky investment. So I did my degree in economics, so it's hard for me to classify one thing as good or bad or risky or not. I think relative to maybe public stocks or public markets, I guess venture is, number one, illiquid. So it's not something you can sell on the Bursa or the stock exchange. Number two is that from a statistical point of view, it's quote-unquote relatively risky, but on a risk-adjusted basis, is it really as risky? I think that's debatable. The liquidity horizon for VC investments typically has been relatively long. So I guess if we look at broad studies, then they will say it's been 10 years odd or so. A fund life is typically 10 to 12 years. But that period has been actually getting longer over time. For a later stage company, if you get in very close to IPO, then actually that window could be also significantly shorter. So while the averages tell a story, I think the reality really depends on what you're actually doing and what space you're actively involved in. Yes, I think most businesses fail on average, but in the first place, you wouldn't be looking at averages and you wouldn't be looking at the 100% or the broad universe of companies anyway. In most cases, the high-level job of an investor is to firstly capture all this information, all this white noise coming in, be able to quickly filter out the 90% of sources that may or may not make sense, and be able to hone in and focus on the 5 to 10% that actually start to make sense at the initial stages. The truth is, there's no ability to actually physically go through everything. That doesn't happen in reality. So while the statistics talk about everything, in reality, you don't. So do you really need a 1 in a million chance to make something happen? On average, yes. But from the perspective of the investor and probably the entrepreneur, the answer is probably not. Ultimately, statistics can tell one story, but usually it's an average story. But we're not average participants, so we don't look at things on an average perspective.
You mentioned about you had a degree in economics. From what I know, it's from Cambridge. right? So I believe some part of that would be having some influence from your family or your upbringing, right? How much of who you are today and your interest in business, in VC was influenced by your upbringing and your environment?
The short answer is quite a fair bit. I believe that all of us are the sum of our experiences in the past. So from young, I have been exposed to some form of, I guess, business or entrepreneurship. Both my mom and dad were in some point of life were entrepreneurs of some form, but they also had some form of corporate career of sorts. Being able to, I guess, experience that from young and be inspired or encouraged by that led to, I guess, an early exposure in entrepreneurship and I guess to some extent venture. So when I entered university, I knew that, either I wanted to build a successful career in some form of corporate life or I wanted to start a business one day. I think the truth is that when you're 20, what do you know, right? So those are just ambitions and dreams at that point. But with certainty, I think there was a very big element or contribution in that factor. So I can only be thankful and grateful for how that started out and where I am today.
Yeah, I think that perfectly describes, in the 20s, you probably don't know what we want as well. Me and YC, actually, just for the benefit of the audience, right? We actually know each other from my previous workplace, one of the largest family conglomerate in Malaysia. So I always call him as my business mentor. And he is also the reason why I would gladly say, and I take pride in saying that as well, he's also the reason why we and myself is using interactive brokers today. Would you agree to that? Do you still remember 4 years ago, I've been asking you a lot about interactive brokers and investing?
Yeah, it's about 4 years ago during COVID, I remember, yes.
I was just scrolling through our chat just to make sure that I got a date exactly when we first talked to each other. And wow, 2020, when we started with the digital bank project. Well, let's go back to, obviously you have seen both sides of the coin, being an entrepreneur, building a business, and also as a VC, investing in entrepreneurs and also their businesses. Let's talk a bit more on the skills of an entrepreneur. What do you think a successful business builder / entrepreneur needs?
Okay, maybe the first thing I'll caveat is that when we look at success, most people don't look at the hindsight of success or what leads to success. And the truth is, almost everything needs to turn out right to lead to success. Now, the keyword I use there, or emphasize there, is turn out, because in most circumstances, they never turn out right in the first place. If I were to list out the top three traits I think are important, the number one trait has to be grit and grit/resilience, right? Because, it's like Murphy's Law, whatever can go wrong will go wrong. If at any point you give up along that journey, then that's the end. There are only two things that make a business fail. Number one, cash runs out or you give up. So if at any point, any of those two items are allowed to happen, and I use the word allowed, because it's really up to the entrepreneur to allow that to happen or not, then the business is dead. I think the second trait I would epitomize would really be the ability to execute. Ideas are cheap. Everybody can talk about ideas, but how many people have the ability to take, a sentence or an idea and make it real in the sense of making a sale, making a product, building a team? That ability to execute far surpasses most other abilities I've seen in the market. So the third trait I would emphasize on in the ability of an entrepreneur is the ability to build a team and scale themselves. If they aren't able to do that, it's very difficult to build a business that is meaningful, to be honest.
Just on your second point, you mentioned that the ability to execute, and I think you know this very well. That's one of the main reasons I'm drawn to you a lot back then during the, where we were. YC is just built different compared to, I guess you can also agree when we talk to consultants for projects, slides upon slides, ideas, business models for weeks, if not months on end, and nothing gets done. What YC said struck me a lot, you don't need so much fancy slides. Just get down to the ground, call the person, run to the office, talk to the person, make the string happen, get things running first, right? Even though you may not have the perfect plan laid out. And I think, I wouldn't say VC, but mostly as an entrepreneur, getting it done is more important than having the perfect plan laid out.
By far, no disrespect to consultants. Strategy, slides, and models have their place, but ultimately the outcome is what matters, right? So the key trait that I think is really important here is that everybody tries to be perfect. Everybody tries to have the perfect plan, but I think two things. Number one is perfection is actually the enemy of good, and number two, inertia is usually the biggest impediment to progress. So if you want to progress, you need to stop being stuck where you are, buried by plans or models or whatever strategy and so on and so forth. That has its place, but ultimately to get from 0 to 1 is taking that first step, and then taking a second step, and then the third step, and then until the 1,000th step, and so on and so forth. But that all involves taking steps.
And when you mentioned the keyword strategy, right? One of the most common strategy, or most common skill strategy / trait an entrepreneur needs is networking, right? Correct me if I'm wrong. How important is networking to you, let's say, as a VC / entrepreneur?
As a VC investor, your goal is to find great investments. As an entrepreneur, your goal is to make something out of nothing or make a business real in terms of driving revenue and whatsoever. So building a network to make those outcomes happen is highly important. Now, the question really is, do you need a network prior or is it a network after, right? As an example, what if you start out in an industry where you have no network? Does that mean you're doomed to failure? I think the short answer is no. Of course, having a network helps. It's a step up. But is it a necessary step? Is it a step which, as an investor, I would deem necessary to drive success? I don't think so. It is an important factor. Let's not get that wrong. But does that mean this individual or this entrepreneur isn't able to build a network from scratch? I've seen people build networks from scratch with no prior experience and no prior background. And it really comes down to the individual's ability to hustle, to build up knowledge from nothing without faking it too much, and ultimately to eventually become a domain expert in a very short span of time. And by doing so, and in doing so, create a network around that ultimately drives whether it's customers or whether it's like potential investees and so on and so forth. So I think networks are important, but is it a precondition or a post-condition? Is debatable.
So I'm asking this question because now I'm at a phase where, business is running, operations are well, but then that comes in, we always have this bottleneck where sometimes the business just doesn't have enough incoming sales / revenue or contracts, right? Then networking inevitably comes into the picture. I mean, obviously there are good and bad networks. How do you sift through all those, right? Do I just go to all networks because all networking events because no networks are bad networks? They could be, useful 5 years down the road, 3 years down the road, or he or she could know someone. What do you think about it?
So let's break it down, right? Like we talk about sales. Let's use sales as a starting point. If your objective is sales, and by the way, in venture capital, a big part of the job is actually sales as well, whether it's selling to companies, entrepreneurs, or selling to investors, right? When we talk about sales, networking is one potential channel into your sales funnel. It's not the only channel. There are many channels. When I look at a business, for example, is this model something you can replicate? Like if we removed you from the picture, are you able to keep that networking engine going? Could it be replaced with 10 other mini Waysets in this case, right? So there's this popular book called Predictable Revenue, which I strongly recommend most entrepreneurs read up on. And this is really a case study or a lesson in being able to scale oneself beyond the founder doing founder-led sales to an organization being a sales-led organization. Networking, to me, is one of those channels. And are you able to create a sales engine from which networking is one of those channels? If you are, and the results or the ROI on that sales channel is meaningful, then by all means, do it. If the ROI from another channel, whether it's like Facebook ads or Google ads, or it could be flyers or cold calling or whatsoever, is higher, then that's where you should be devoting your efforts to as an organization or as an individual. That's how I would think about decision making when it comes to those. But the last thing I would add to that is that ultimately, I don't believe in a silver bullet. I mean, if you're lucky, then great, you have a silver bullet. Hope is not a strategy, so I wouldn't hope on luck. So what I would assume is that in a business or in a sales organization, you typically have maybe 3 to 5 different primary sources of sales. Maybe they're all equal. Maybe it's highly skewed towards 1 or 2, right? But that's how I would think about prioritizing efforts. Pick your top 3. If networking is one of those, then double down. Try to productize networking in this case. And productizing here basically means how do I make it so predictable and boring that it becomes repeatable, that I can do it day in, day out, and more importantly, scale the business beyond myself to make it happen. If you can do that, then by all means, go for it.
That's in the pretext of I might have experience in networking and know whether it works or not for this business already, or I can quantify it already, right? But what if I come from someone that is so vanilla, like myself, where I can't really quantify the effects of network yet? Should I still devote like a portion of my time to like experiment it out?
I'm a big advocate of experimenting, and the way I would think about it would be if I was at an early stage of a business and I wasn't sure what was working, I would most certainly devote a good 20, 25, 30% of my time to networking, not just for the purpose of getting sales, but for the purpose of also just learning. So what are people doing out there? What are the peripheral vendors in my business that I need to know? Because maybe I get sales from there, but if I don't, it's a no regret move because these are people I should know anyway. If you keep doing that for a while, you immediately become a domain expert. That's number one. And number two, at some point, you would then be able to dictate like, oh, okay, like these networking events or initiatives I'm going to, is it bringing me results from a sales perspective, or have I learned enough? If those metrics have stalled, then you know that your time is less worthwhile to do so. You can then make a gut judgment call 1 month in, 2 months in, 3 months in. At some point, you realize it's getting tiring. It's not bringing in results. Maybe I should taper off. And I think that method of experimenting, whether it's networking or something else completely different, is really the right approach.
So basically, it's experiment until you realize where it doesn't give enough or substantial ROI for your time, then move on.
I think so. I mean, like ultimately, as a business owner or as an entrepreneur, or even as an individual, again, you have 24 hours a day and you got to sleep for a third of it roughly, right? So you don't have much time. And chances are half of those things you're going to make mistakes in anyway. Over time, you just need to make more right decisions than wrong decisions. And when you make wrong decisions, you limit the size of those mistakes. When you make right decisions, you double down. Do you know what those right decisions and wrong decisions are at this point of time ahead in the future? The answer is no, you don't.
True.
Yeah, so it's a process.
You mentioned time. I know you personally. We had lunch and meals before already. I roughly know what you're working on. There's numerous projects and businesses you're working on. Like, what are you currently working on for the benefit of the audience? What are the current projects you're working on?
Oh, that's a tough question. So I am doing a bunch of random stuff. Okay, for the record, I like to do random stuff and I like to keep busy, as you've known in the past. My basic rule is to work on meaningful things with meaningful people. And I've stolen that from Ray Dalio, but unashamedly, that's what I do. As of now, I mean, extremely interested and passionate in these spaces for different reasons. But long story short, I think like it's been an eventful 1-2 years and I'm extremely excited to see what comes out of these things.
But there is no reason for you to stretch yourself so thin, right? Because I think we had this conversation before, like previously when you talked to me, you were working on like 6 different companies, 6 different projects, right? How do you manage your time that you're able to devote them equally, if not, best manage your time to make sure that each of the businesses get enough of your attention? Because like, I don't know if work-life balance is even a thing for you.
I guess the first important rule for me is if the work is meaningful and you're working with meaningful people, then it'll be fun. So it has to be fun. If it's not fun, ditch it. Like, stop wasting time, right? It's not worth it. It's not worth your mental health, not worth your physical health, and just forget it, right? So for now, I think that is probably one major measure for me in terms of whether I want to keep focusing on it. That's number one. I think number two is that I've been very fortunate to be blessed with an amazing team and amazing people to work with. And this comes back down to the point about scaling oneself. As an individual human being, I can't do everything. And the truth is, it's very difficult to do so. So if you look at, let's say, Elon Musk and see how he runs like multiple multi-billion-dollar companies at the same time. First and foremost, he doesn't run it himself. He has a massive team behind him. And what he's really been good at has been building these teams, enabling them, and pushing them in the right direction per business unit. So I like to think that I'm taking a page out of that book, and I've been blessed with an amazing team that I've managed to align with in terms of their interest, their personal interest and their professional interest towards each particular business, and been able to scale from that perspective. So I think from a work-life perspective, I would actually argue it's relatively balanced but extremely tight. But the bottom line is I have an amazing team I can count on, I can trust, and I can work with to pursue all these interests.
So you've managed to incorporate the fun element into your business, essentially, right?
I don't know if I tricked myself to doing so. I don't know whether it's something I've gotten drunk on, but Sean says yes, yeah. If you aren't able to do so, I think you go crazy.
So, YC, what does the 1% know about investing in businesses and make multiplying money seem so easy and fast that the 99% doesn't know?
Now, this question assumes that the 1% actually know what they're doing, which is arguable. Let's leave it at that. Do I know what I'm doing half the time? I debate that, but I'm not gonna, for all my professional investors out there and LPs who are invested in my funds, let's just ignore that for a second. If I assume that I'm one of the 1%, and I look back at my life, and I have to break it up into pieces that have led to this point. Let's say pre-university, post-university / first job, the 30-year-old mark, and then the post-35 range. If I look back at those stages of my life, the truth is pre-30, I didn't know what I was doing. And whatever I had assumed back then, I assume most of the audience, when you were like 20 or 18 or even 15, you had all these dreams about your career or your family and your life and so on and so forth. I hope that most of you made it. For me, I didn't. Whatever I had assumed back when I was 20, I knew I was so far off by I was 25. And I had already ditched them out the window. So I think the first realization was realizing that I didn't know very much. And I had so much to learn. I think step 2 was that realizing that, especially between the ages of 20 and 30, I wasn't going to get rich. You can define rich however you want, but I wasn't going to quote unquote, make it in that age range. Regardless of what I was earning, regardless of whatever job I was doing. I could have been in the highest paying job for that age group at that stage, and I wouldn't have quote unquote made it. So the key thing at that range, I feel, regardless of whoever you are or whatever you do, is that age range needs to prepare you for what happens after, right? Because you're only really going to really ramp up, whether it's earnings or skills or whatever in life, post that age range. Obviously, if you can get there faster, that's better. It compounds. But let's just assume that for vast majority of people, that's the typical standard. So whatever you do in the age range needs to lay the foundations for post-study. And then post-study, if you assume those are your golden years, presumably, then that's when you really need to double down on whatever really matters to quote-unquote make it, or focus on what really matters. So to me, in hindsight, if I were to advise my younger self, that is an extremely important time to explore, learn, invest, but not invest in money, but invest in yourself. And that may include investing financially, to make mistakes, to learn, to grow, and ultimately to play. Because if you aren't able to be a holistic individual and be ready to take advantage of all those experiences when you're actually meant to really accelerate from a financial perspective, then I guess by definition, you won't be at your peak performance. So I think if I were to look back, having had that experience, a very varied experience, having had the ability to make mistakes, having the ability to realize that, hey, I will always make mistakes. Here's how I get better, or here's how I rebound or get up from those mistakes to do better, or how I limit and stop loss those mistakes and try to find the profitable, trades in that respect. That entire decade or that period of time was extremely important to get to that stage. And humility would have probably been the bedrock of getting all that knowledge, because if you aren't humble enough to realize you make mistakes, then obviously none of that matters. Now, I think irrespective of whatever, anybody does after that stage, it could be engineering, it could be in finance, it could be in starting a business, it doesn't matter what. If you're prepared to take advantage of whatever you've learned and all your skills and so on and so forth in whatever you're doing, then you can really maximize at that point. You're ultimately preparing for that stage of your life. That's how I see it.
So basically, luck to me is luck equals to opportunity meets preparation. You need to be prepared to a certain point where when opportunity strikes, then you are in luck. But basically, if you're not prepared, when opportunity comes, you're not ready to wing it. So let's dive right on into venture capitalists in your VC experience, because we mentioned a lot about building business, finding business, building business, scaling it, and maybe eventually selling it, right? So let's dive into how do you find startups that you want to or you wish to invest in? Like, very briefly, the due diligence process. Is it just like hitting, hey, you got a business or whatever? Or how do you actually find them?
Just to put things in perspective, between 90 to 99% of companies out there are deemed SMEs or startups. So the number of entrepreneurs or companies out there is staggering. Okay, so that's number one. I think to answer that question, I would first define are you in early stage investor? Are you mid stage investor? Or are you late stage investor? Because the process actually changes slightly as you go through the phases. But so let's assume you're an early stage investor, which is where I started my career. At an early stage, at 0 to 1, basically, what really matters? Basically, there's nothing in the business. It doesn't exist, right? Or there's literally a sale or a very simple product at most. So the truth is, the business doesn't really have any other assets besides the founder or the founding team in this case. So all you really have to judge the business at that stage is really that. Everything else is theoretical and or may not exist, to be honest.
The proof of concept.
Yeah, I would even draw back proof of concept. I would focus on the three things I said earlier, right? The founder's grit and resilience, the founder's ability to execute and make something out of nothing, and the founder's ability to build a team and scale the business. Proof of concept falls in number 2, which is ability to make something happen out of nothing, or ability to execute. I think what's really helped me in the past has been, given that I myself have been an entrepreneur, the ability to recognize patterns and quick pattern recognition allows for quick sifting or filtering of human beings in this case. Being able to recognize whether it's from basic experience as this founder exhibit those abilities. And to be honest, you are constantly, whether it's in one conversation or multiple conversations and meetings, you're constantly prodding and nudging to get a sense and feel of, hey, does this person fit this criteria? I think that's step 1. I would say that this step 1 is probably a good 50% or more of that evaluation. I think step 2 part would be really like, is this person working on something meaningful? This can have many hidden meanings. Meaningful may mean, impactful, like saving the world or reducing pollution and climate change and so on. So I think that's one part. I think another part is like, is it meaningful from a venture perspective? Do I believe that it will become a multi-billion-dollar outcome today or tomorrow or 5 years' time? I need to make a judgment call on that sector, on that space. So step 2 is really about deciding, is this endeavor a meaningful endeavor? Is this person working on something that's meaningful today? Or hang on, maybe this person is not working on something meaningful today, but you know that whatever this person is working on in the future may be meaningful. So do I bet on this person today or not? Right?
So it's also partially market trends?
Partially market trends, and the fact that the founder today may not be building something you want to invest in today, but may potentially build something that you want to invest in tomorrow.
So it's their foresight, basically.
Or your foresight. Should you invest today or not? Knowing that it's not what you want to invest in, but you know that the person on the founding team is the right team to invest in. I think at this stage, especially the early stage, it's particularly important to, number 1, pattern recognition and the ability to filter signals very quickly. Number 2 is the ability to, I guess you can call it foresight, although I don't believe in crystal balls, but the ability to lay down bets and size up your bets accordingly over time. And the emphasis is over time. You start out with limited information. Maybe you just know that this founder and this founding team has built a very basic product. You don't know. You have an inkling what it could be in the future, but you're really imagining and you're dreaming. Let's start from the end, right? Like, to succeed, you need to see this dream become a reality. And you can make judgment calls of how real this dream may be today, but how do you make those decisions over time? Because as time progresses, those odds change. As an investor, that's how I would approach venture, but not just venture. I think life in general, portfolio investing, I think should take that approach. It's an iterative, progressive approach. And ultimately, you want to end up with the success at the end of it, which is whether you're 20% IRR or your unicorn outcome or whatever, but that's actually the outcome, not the process, and definitely not the beginning.
So what I'm hearing is that's in the context of early stage. So a lot of it still relies on qualitative, right? Yeah. Less numbers. But at what stage where would you look into the numbers, any metrics or indicator that helps you make a lot of the decision when it comes to finding a good potential company?
Good question. So earlier we talked about early stage. When I start actively looking at numbers is when what I call product market fit starts to materialize. So the best way I like to define it is PMF happens when people are running to your door to knock on a door and gives you money in your hand and says, I want your product. Give it to me. As an investor, you want to get a strong sense of PMF. Now, you don't get a strong sense of PMF when someone says, I have 1 million users on my app. I mean, that's one metric to judge. But if you go one level deeper, it's like, okay, you have your surface level metrics, and now you want to get a sense of like, how real are these customers? Are they going to stick around? Are they going to come back multiple times? Like maybe they're going to come back multiple times a day, multiple times a week, a month, a year, for example. How do I measure that value? And how real is it? So now you're looking at real numbers. These are not theoretical numbers anymore. And you need to make a judgment call like, can I safely say that number one, this company or this product has achieved product market fit? And number two, is this product market fit meaningful? Meaning that will this PMF continue into a multi-billion-dollar market or not, right? Maybe it's not a multi-billion-dollar market. Maybe you're happy with a multi-hundred-million-dollar market. I don't know. That approach can be quantitative. So some metrics, just to share, high level at like level 1 would be like total number of sales or total number of users. I think that's a very basic metric. Level 2 is like, okay, how engaged or how in love with this are these customers with the product?
User retention?
Retention is one way. You can measure it in a very basic manner. If you really want to go in depth, I would do what we call a cohort analysis. The customers that came in March versus the customers that came in April. How did they react, or how engaged were they versus the month before? Because by doing so, number one, you can break it up into groups. Number two, you can start to say, hey, in March, we actually did a launch campaign on XYZ, and that's what drove retention, or maybe it was just a holiday period. I don't know. So but it gives you an idea or clues as to the qualitative reasons to the quantitative outcomes. Okay, so co-analysis is extremely powerful and useful. After that would be NPS scores. If you are able to do unbiased NPS surveys, Net Promoter Scores. So as long as they score above, I think 8, 9, 10, I believe, that means the customers are raving about the product. And by the way, not all industries are able to score high on NPS. So for example, logistics tends to score relatively low on NPS. But then how do you benchmark against everybody else? If you're able to benchmark against lots of incumbents, your NPS scores, which may not be 80%, but maybe like 40%, but your 40% beats the industry's 10%, that sounds great.
It's relative.
It is relative in that sense, right? Building a sense of PMF based on those metrics is highly important at probably like the Series A, Series B mark onwards, I would say. That stage, you want to get a sense, okay, proof of concept is out. This team has taken it from 0 to 1. Are they able to take it from 1 to 10? Does this product or this company have some form of PMF that I can really put substantial cash or capital behind? That I can really help to grow a sales organization to blast out the gates? Because the truth is, if you are spending $10 million in ads and you don't have PMF, it's a bit of a waste of money.
So from an investor or VC's perspective, do you care if your upcoming investment synergizes with your existing portfolio?
From an individual investor perspective, the short answer is partially. Just because if I'm looking at one logistics company, for example, whatever I've learned in this study, I can use in my next. So it's synergy from an analysis point of view, that's for sure. At the end of the day, each investment needs to stand on its own. So technically, no, you don't need a synergy there. However, if they're able to help each other, and by virtue of being an investment, you're able to drive that, sure. I don't believe you need to make an investment to push a partnership. Of course, it's easier. You already have a connection. That can happen without having an equity stake or stake in a company. I think maybe harder relatively, but not difficult, not impossible. So I think like as an individual investor, synergies do help. Are they necessary? Sean says no. It also comes down to how diversified you want your portfolio to be. But not everybody wants their portfolio to be diversified. So if I was a pure financial investor, there's a good chance I might want to spend a bit of focused time on a particular sector, but I may not want to be fully concentrated on one sector for diversification purposes. But I also don't want to be overly diversified. So finding that balance and then finding the LP investors that want to back that balance, I think is probably the biggest challenge there.
So is it correct to say that while synergy is a nice to have leverage for a copy-paste playbook, it can also backfire in the sense that there will be conflict of interest, then you would cannibalize each other?
Assuming the same market, same geographies, yeah, potentially.
So over the past, I don't know how many investments you have done before, has emotions ever play a big role in terms of making that decision of maybe this is the founder or the entrepreneur I liked? Because a lot of the early stage is qualitative, right? So I presume emotion is part of it.
So I think like we're all human, so there are always emotions. I think that's number one. But especially at the early stage, less so at the late stage, but especially at early stage where the truth is it's a numbers game. You don't know who's going to succeed or not. Now you make a best guess estimate, like I believe in this person, whether or not they will succeed. Let's just say, as an example, 10 solid founders a year with a fixed size check into a particular subset of industries or a set of industries. The truth is, if you believe in that strategy and you have a track record of making that strategy work, it doesn't matter whether those 10 work or not. Assuming the strategy continues to work, but you consistently deploy on that strategy, then in theory, over the long run or over the portfolio, numbers will catch up. If your strategy is meant to work, not saying it does, but if it's meant to work, then you should just be consistent.
So that's essentially saying as long as you have outsized or outweighed winning bets, you can in a way ignore the losing bets.
I think mathematically speaking, that's true. I mean, like if out of 10 investments, one investment makes a 100x return, which is a 10% outcome. But that means that 100x not only pays for the 1x of the 9 investments, which is now is 91x, but that 91x then becomes net of your original investment. You got 90x net returns. I mean, the numbers speak for themselves. It's not, there are no emotions involved.
I presume it's pretty common to see failures in startups. How do you cope with that? Is it very normal in that sense?
It's very normal.
It's very normal.
It's very normal, and the truth is, failures are bound to happen. I mean, remember, let's come back to humility. Failures will happen. You just don't know how or when or whatever may happen, right? But it will happen without a doubt. I think the investor that thinks they'll never get it wrong is doomed to fail, by definition, because it's impossible.
Does it ever bother you? Like, let's say out of 20 companies, only one succeed. You are wasting so much time in the 19. Does it ever bother you or eats into you?
I feel the emotional and physical stress and pain of the founders, and I empathize with them completely, especially having been one myself. But is it unexpected? Answer is no. Is that unexpected to them? I hope it wasn't unexpected, because if it was unexpected, then it's going to be a bit more of a roller coaster for them. But am I personally emotionally affected? As a friend, yes. As a professional, no. I mean, if it happens, it happens.
Would you still give them
money?
Subsequent ventures fund?
I think if they carry themselves well and they executed well and they prove themselves, why not? For sure. Given that now it's sunk cost, it's basically tuition fee. It's like university degree, number 2 or number 3. It comes back down to my fundamentals earlier. If you believe in the ability, you believe in the space for the next venture, go for it.
All right, let's talk about post-acquisition or post-investment. I think in your LinkedIn profile, you take pride yourself as a builder. You create value, you drive value, right, to the business. So what are the strategies you deploy, or what do you do to create value post-acquisition for the company?
All right, so all companies are different, but I'm going to start by generalizing to make our life a bit easier. So I like this rule that was taught to me about 15, 20 years ago. Revenues before cost, better before cheaper. Not always the case, but like as a general rule, it's a good rule to follow. First and largest typical value-adding driver is how do you grow revenues. There are direct ways to grow revenue and there are indirect ways to grow revenue. Direct ways are, I'm going to go knock on doors and get sales, full stop. Right? I'm just going to make sales happen. Indirect ways are like, okay, you have an unfinished product, or you don't have a sales team. You have to do this first before you can build sales, or you can generate sales. In this case, build a team. So biggest value driver, try to drive sales immediately, because sales tells you if people like your product. Sales tells you if people will stick for your product. Sales tells you if your product even makes sense or is sellable, and whether this founder or founding team is able to sell in the first place. So sales is number 1. Actually, it's number 1 for a long time, forever, most of the time. But the second part is like, actually, maybe you don't have to push sales first. Maybe you need to scale the team. In most cases, you need to scale the team. Or you need to scale the founder, in this case. How do you do that? Usually you build a team. I think hiring is one of the most underrated skills ever. But helping the team hire and build the team is, I think, another area I like to focus my time on.
How would you prioritize that in terms of for your business?
You can blame me for being a very simple guy, but to me, a business model means I have a product. It costs me like $50 to make. I sell it for $500, and I make a GP margin and a margin on top of that. That's one step. But maybe I'm biased, and maybe I'm jaded by the number of businesses I've seen, so maybe that's why I treat it so lightly. But to me, as long as I have a decent understanding of a very straightforward transaction, I think like in this clear PMF in that regard. And last but not least, the quote unquote business model is not too complicated. You don't restrict the customer from giving you the money that they want to give you. I think that works. All right. So assuming that PMF is clear and assuming that the business model is straightforward enough, you now need to scale the business. And usually I would start from, if you don't have any engineering constraints or product constraints or tech constraints, typically I like to focus on sales because you're going to be perfecting the product for the next 10 years anyway. So I like to see the product get into the hands of customers and show me PMF at some point. So this is a popular saying. It may sound a bit blasphemous, but if cash is king, distribution is God. In today's world, cash is a relatively cheap commodity. Capital is a relatively cheap commodity. Not always the case, but let's say you get funding. It's actually quite difficult to spend a lot of money very fast in the early stages. So what you really need to do as an entrepreneur or CEO is like having a portfolio. If you have $1 million sitting in your bank account and it's doing nothing, it's sitting in cash, you're not a very good portfolio manager. Although most people do that, that's fine. But like from a definition of PM, you're not doing very well. So as a CEO, it's the same thing. You have a bunch of resources at your disposal. You got people, you got network, maybe customers, you got capital. Assuming you're fundraised, now you need to deploy this capital to good use. You could spend on ads, which if you don't have PMF sucks. You could spend on a team to build, whether it's devoted to engineering, product, sales, or whatsoever. I tend to like to focus on helping teams build themselves. The reason I like to focus on that is because I find that most people don't focus on that enough. That's number one. And number two, I find that most people sub-optimize on hiring.
How do you make sure that it's not redundant and you're not just addressing a lot short-term problems, but actually align with your long-term values? Because I think this is probably the crux of hiring and the problem that a lot of entrepreneurs, CEOs, or I think at every scale of the businesses will face. I mean, down the road, HR's problem, but I think at a very high level, maybe for startups or small companies, this is probably their struggle because cost is still a constraint, right?
Sure, but you're jumping to the conclusion. So the conclusion is that all those things matter. True. How do I get to the conclusion? Again, comes back down to process. How do I get to the conclusion of having the right hires, having the right cost structure, having the right outcomes? Because that's the outcome I want. I mean, of course, if I can get it right the first time around, that's great. But hope is not a strategy. Luck is not a strategy. Let's not depend on that. How will you do it without relying on those factors? What is a repeatable process that you can adopt to do that, to get to that point of quote unquote outcome and success? So step one is today versus tomorrow. I need to achieve those outcomes tomorrow, not today. I mean, of course, it's great if I achieve them today, but realistically, I need to achieve them tomorrow. Okay? So what would I do today in the short term? First step is I know I need to hire that gem. But who is that gem and how do I find that person? Short answer is not by going through 1,000 CVs. I mean, you can, but I don't think it's an efficient use of resources. Every moment that you look through a CV is a moment that you don't have that person working on the ground. Every moment you look through a CV is another moment that you're not testing that untested person in real life. And the truth is, you only know that the person is the right candidate after that real life test. Not the CV scouring or the CV review. That's irrelevant. I mean, it's relevant to get to that point, but in hindsight, it's not relevant. The outcome is having that battle-hardened veteran, that battle-scarred individual, that culturally assimilated, integrated individual in your team.
What are the common mistakes you've seen entrepreneurs do when it comes to hiring and firing?
From a hiring perspective is trying too hard to be perfect in finding the candidates, trying too hard to be perfect in optimizing cost and I guess salary numbers and all these things. Yeah. To me, I think that's a common quote-unquote
so not
hurdle.
Realizing the 10x but focusing on the 1x.
Yeah, or focusing on what's in front of them, really. I mean, what really matters is the 10x outcome.
True.
Yeah, unless you're running out of cash, then maybe it's a different story. But like to me, the 10x outcome is what matters. So that's on the hiring front as a quick answer. On the firing front, the short answer is not firing fast enough and not doing that process well. So firing is not something like, you show up on like The Apprentice and you say you're fired. Like it doesn't work like that. It's an ongoing process for yourself and for the candidate and the team. For yourself, you're not going to wake up one morning and realize this person needs to be fired. Are you able to be disciplined enough to track those breadcrumbs?
AKA KPI.
Yeah. And being able to do that regularly and frequently. I think that's number one. Number two, whether the candidate sucks or not doesn't mean they perpetually suck. Maybe as a manager, maybe I did a bad job of communicating their job scope. It's only fair that in that probationary period or that period of time, I do my best as an employer or manager to the candidate. Have I communicated myself well? Have I even put them in a point of failure or success? Like, are they meant to fail? Did I put them in a place where they're meant to fail? If I did, then that's kind of my fault. And have I given them the opportunities to succeed? Have I enabled them well as a manager? If I have not, if I've done a good job of hiring, but I have not enabled them well, then they're not going to do well. And it's kind of my fault. In most cases, it's almost never the candidate's fault.
So a lot of it is also upfront deliverance of the communication of the expectations and the KPIs and objectives required, maybe for the first 3 months probation.
Communication and enablement. Just because I've communicated it, but let's say I don't onboard them well and I don't introduce them to the rest of the team, I don't make the right, provide the right background or tools or whatsoever, again, I'm setting them up for failure. And arguably, it's kind of my fault if I do that.
So as a head of business, how do you make sure that, or how do you deliver the news of firing or letting go without letting it affect the wider team? Because obviously in a startups, small companies, an employee is probably 10 or 20% of the entire team.
Yep.
Right.
Yep. So I think first and foremost is consistency. Culturally, does your organization practice the hire fast, fire fast philosophy? If you do, and you reward for efficiency, then by definition, I think it's understood. Like, I'm here to deliver. If I'm unable to deliver, I'm out. But in exchange for the risk, I get higher than expected pay, or I have a higher upside in the long run, for example, right? I think that's step one. Culture sets the tone. I think step two is having the regularity and the frequency and the consistency to deliver on those outcomes. Let's say I set a bunch of KPIs. How often do I follow up? How often do I measure? How often do I give feedback? Ideally once a month, right? Ideally once a month. If I deliver feedback on month 1, month 2, month 3, and month 3 happens to be the last feedback session, can I score them and say, hey, you've passed or you failed based on this score? And if it's unfortunate, then you didn't make the cut. If it's fortunate, congratulations. That's one example. Can you do that 100 times? Consistency and frequency.
So it's making it a numbers game so that the emotions part is as little as possible.
Of course. Emotions still come into play, but yes, at the end of the day, you approach it very rationally and logically.
So let's say everything aligns and the startup you invested in, grew and had Series A or whatever. When would you consider to sell your business, or what are the triggering factors for you as an investor, let's say from an early startup?
Sure. So depends if there's a perspective of an individual or perspective as an institution. I'll start off as an individual. So when I'm an angel investor, naturally, I try to be first money in, first 1 or 2 rounds effectively to get in at the right price for myself as an individual. I've given myself a set of rules to follow, and I highly recommend rules to people. You can hold it to forever, but that assumes you have liquidity in the future. So my personal rules are 10x, sell half.
10x, sell half. Basically take profit.
Yeah, take profit, 10x, sell half. When you can, if the opportunity arises. So for VC-related investments, they're liquid, so you may not have the opportunity, but as a general rule, I think it's a safe rule. Why? Because no one ever went broke booking gains, right? So lock in your gains, redeploy your capital, recycle your capital, and reinvest. The remaining 50%, if you hit another 3 to 5x, I would sell another 50%.
But that's assuming you know or you already have opportunities to deploy your capital again. But what if there is none? I don't know whether I can say there is none, presumably.
To deploy?
The market is slow and you got nowhere to deploy.
Yeah, then go on holiday. Have a set of rules as an investor and then follow them.
So when you're doing that, how do you essentially prepare for that transition? Because obviously, let's say selling 50%, that's fine. You still have stake. You are still involved in the business, right?
Yeah.
Actually, maybe just one step back. How involved are you day to day, week to week on a business? Let's say you invested in a founder or a startup or a series A or whatever. Yeah. How involved are you in the business?
Okay.
Until they sell off or what?
Clarify before I answer that question is what type of business. So for the vast majority of my investments, I am a super minority. 1%, 2% shareholder, whatsoever. In those cases, I'm very not involved. It's like, hey, founder, Mr. Mrs. Founder, I believe in you. Here's some money. Good luck. If you need help, give me a ring. and I'll help in any way I can. That's how the relationship works, right? Because for that super minority position, I'm really just trusting the founder and the founding team to just execute. And I wish you all the best. You have all the upside. Good luck. If it's a business where I hold a significant stake, I would say north of 20, 30%, maybe even to some extent a 10% stake, I would then start to get more involved, relatively. So it's really a function of how big your stake is, how concentrated you are in the business. And that determines how involved you are in the business. That should determine how involved you are in the business. Okay? So that's step one. Step two, to answer your question, how involved am I on a general basis, right? Again, the vast majority, I'm super minority. I try my best to stay in touch with the founders on a regular basis to ensure that where I can help, I will. But that's not always the case. And when you have a portfolio, you just have to have the discipline to constantly knock on doors and say, hey, Wizard, you doing all right? Anything I help with?
Follow-ups.
Yeah, just follow up. And it's a two-way street, by the way. It's not just an investor's responsibility. It's also the company's responsibility, but it's a two-way street. So for example, let's say making a large investment size-wise, hopefully stake-wise. Maybe I have to get more involved in from an M&A perspective or corporate finance perspective or exercise. Sure, that's our area of expertise. Let's help out. Where we have a much larger stake, maybe I want to get more involved operationally. Just because I have a large stake, then I'll help out. So for example, one of my portcos run by my partner is a laundry business. I've spent 6 months living in a laundry shop, sweating it out, folding clothes, ironing stuff, literally washing clothes for 24 hours. Did I have to? The answer is no. But I did have a sizable stake. It was a very meaningful business. I think at that stage it was at least the 0 to 1 phase of the business. Does it make sense from a financial point of view? Of course not, it doesn't. But that's not the point. Yeah.
You like the game?
Like the game, yeah. Let's keep playing.
Let's talk about price. If you were given the say, right? Because most of your investments are super minority, so I'll presume that you don't get to determine the sale price of the business. Or maybe not, right? Correct me if I'm wrong. But let's say you have a much more substantial stake and you get to determine the valuation to sell your stake, right? What are the things you do, or how do you make sure that you get the best possible price for your sales?
By definition, a sale is a meeting of minds or the equilibrium between a buyer and seller. So I can do my best to set a price. But if there's no market, there's no market. Okay? Let's get it out of the way first. Because everybody wants to set the price and everybody wants the highest price. On the other side, the buyer side, is the opposite, right? So you need to have a meeting of minds to align, otherwise no deal happens. And then, I'm just sitting on a price in my head that has no reality, okay? The best time to sell is when you don't have to sell. Just like the best time to raise money is when you don't need money, because you're not desperate. You can say no and walk away. You don't need to be stuck. And you don't need to be driven by desperation, which is an emotion.
So then your negotiation power goes up.
Yeah, I guess negotiation power / ability to walk away and say, you know what, this is not going to work. Let's talk again in 6 months or 12 months or whatever it is, right? So to me, start by answering those 4 questions. But that will tell you where you stand. If you are run out of money and you're completely overdrawn and you have $10 million of debt hanging over your head, you need to sell yesterday at whatever price. If you are the opposite, then you can dictate the price.
You as a buyer, you can smell that desperation.
At the end of the day, I think the way I would approach a sale is, number one, prepare way ahead of time. You don't approach a sale when you have to sell. That sucks. I prefer to be in a position to be able to say no. Because amateurs negotiate on price, pros negotiate on terms. Price is just one thing. Okay, I want to buy your iPad for $100. And you come back, you know what? I want $200 for it. I can choose to say yes or no at that point. But what if there's a third answer, fourth answer, fifth answer? So I say, well, if you want to sell to me for double the price, how about you throw in that mic and I'll pay you 100 today and 100 a year from now, for whatever reason, if it makes sense to me, right? Then you're not limiting yourself on a yes, no, black, white basis anymore, because that kind of sucks. Again, you want to be in a position where you can make decisions or have optionality. If you are unable to do so, then you by definition are stuck, and you can't maximize the sale.
Wow, that's powerful. I love it. You basically identify your position, make sure that you are not in that desperate position to buy or sell, and then also making sure that you have options, but most importantly, you make sure that your buy or your sell process is multidimensional. It's not just a function of price.
Yes, and maybe, just double click on one thing. You talk about desperation. Sometimes you will be put in a position where you're forced to sell or you're like stuck, right? To turn your question slightly around, it'd be, okay, in that circumstance, how do you maximize, or what do you do, right? Like you're stuck, what do you do? First thing is have a strong sense of your stop loss. What do you really need to sell for? Short answer is usually not the highest price. It's the price that gets you scot-free from debt, guarantees, or whatever obligations that you may have. I think that's a short answer. Fine, you've wiped out equity value. Cool. But does the family have to suffer? I mean, arguably not. But hey, hang on a second. You may want to protect yourself. How about the rest of the shareholders and debt holders? Don't they have a right? So first step, know your position. Know where you stand, what you need to protect. What is that price? What is the price to get that protection? Once you know that, then you can determine what's your low end, high end, and so on and so forth. And then I will start from there.
Love that. Thank you very much, Vicey, for this very insightful interview and conversation as well. I learned a lot myself. Hopefully the audience learn as well. Just one last question for you, Vicey. If you could change one thing about your past, what would that be?
Oh, well, firstly, I would want to relive it because I miss it a lot. As I said at the start of this conversation, we are the sum of our experiences. And the truth is I wouldn't be where I am today if not for the mistakes and experiences I've had along the way. So I would have reached out to more prominent people when I was 20. Because that's the age, number one, you have no reason to fear. Even though you are quite fearful, you have no reason to fear. You have nothing to lose. And that's when people take a chance on you. Yeah, I think I was about 20. And I wrote a cold email to, I guess, a prominent person saying, here are 10 reasons why you should hire me and we should have a chat. And he actually answered. I realized in hindsight that was extremely powerful. And I should have done more of that. Yeah. Should have taken more chances.